Are you sick of renting, but you want to know if a mortgage payment is going to be more than your rent, less than your rent, or essentially the same? Well, this video is for you because I'm going to break down the monthly payments for 3 different price points so you can get a better idea of what your monthly payments will look like if you decide to buy. Your monthly payment consists of 4 different things, including principal, interest, property taxes, and home insurance. And for all the examples I give you are going to be based on a conventional loan with 3.5% down, 6.5% interest rate, and a credit score of 760 or above. And I'm actually going to be taking homes straight from the MLS just so I can use their property taxes, so it's as close to what your monthly payment would be as possible. But just know that it does vary based on your credit score and your income and a few other things, so it's not going to be exact, but it'll at least give you a good idea. I'm going to start off with a house in Northeast Minneapolis. This home in particular is in the St. Anthony East neighborhood and is priced at $250,000. So I'm going to break down what that payment is going to look like for you, but just know that I'm estimating home insurance and it's possible that it would be a lot less than what I'm estimating. I just like to overestimate just so you're not getting big surprises, but you do have to get a couple of quotes to do that, so just know that the home insurance could be a little bit cheaper, but I'll break it down for you. All right, so with a purchase price of $250,000 and a down payment of 3.5%, which is equal to $8,750, 6.5% interest rate, and I forgot to mention this at the beginning of the video, but I'm using a 30-year fixed rate mortgage. So for this house, the property taxes annually are $2,214. I'm estimating home insurance, which may be high, like I said, at $1,500 per year. It's a single family home, so there's not going to be any HOA dues. And so this is going to break down to a principal and interest payment of $1,525, homeowner's insurance of $125 a month. For this, because you're putting 3.5% down, you do need mortgage insurance. So estimated at $91. Property taxes, $185, HOAs, $0, bringing you to a monthly total of $1,926 a month. Next up, I'm going to use a house in Bloomington that's priced at $350,000. And I do want to mention the higher the assessed value, the higher the property taxes. So as the price gets higher, so do the property taxes in most cases. All right, so breaking this down, a purchase price of $350,000, a down payment of 3.5%, which is $12,250, 6.5% interest, 30-year fixed. Property taxes for this one are $3,808 per year. Homeowner's insurance, I braised up a little bit to $1,800 per year, and no condo or HOA fees because it's a single family. So this is going to break down to a principal and interest payment of $2,135, homeowner's insurance at $150, the estimated mortgage insurance at $127, which I also think I forgot to mention that you only need this mortgage insurance if you're putting less than 20% down. So if you're putting more than 20% down, you're not going to have this additional part of your payment. Moving on, so the taxes are going to be $318 per month, bringing you to a grand total of $2,730 per month. For the last example, I'm going to use a home in Richfield that's priced at $450,000, so I will go ahead and break that down. So with a purchase price of $450,000, 3.5% down, which would be equal to $15,750, 6.5%, 30-year fixed, property taxes at $5,171 per year. Homeowner's insurance, I kept the same at $1,800 per year. The square footage is kind of the same as the last one, and I don't think it's going to go up that substantially. So this is going to break down to a principal and interest payment of $2,745, homeowner's insurance of $150 per month, estimated mortgage insurance of $163, taxes at $431, bringing you to a grand total of $3,489 per month. If now you're thinking, well, I'm going to need a lot bigger of a down payment because I don't want my payments to be that high, so I'm going to bring a lot more money to closing. That way I can have lower monthly payments. Well, yes, you can do that. The more you bring, the more you have as a down payment, the lower your payment's going to be. However, it's going to take quite a bit to make a substantial difference. And I'm going to show you how using the Richfield house example. So in that example with 3.5% down, which was about $16,000, it was like $15,750. We're just going to say $16,000 to make it easy. And the payment for that was $3,489. Well, if you were to bring even just 10% down, that would be equal to $45,000. And that would only bring your payment down to $3,212. Now, I'm not saying that $277 a month is nothing. I think that's very substantial. But if it means that you need to bring $30,000 more to closing, then it's definitely not worth it. Because think about it. Use 5 years. So if you were going to take another 5 years to save another $30,000, you would miss out on all the equity you could have built if you just bought with a $16,000 down payment. And by the end of those 5 years, it's likely that the house is going to cost more anyway. So all that time you spend saving more money is not even going to decrease your payment by that much. I wanted to give you examples so you could get an idea of what a monthly mortgage payment would look like for you at different price points. But if you want to know what the numbers look like for your specific situation, you should definitely reach out to a lender because they're going to be able to pull your credit and then check your credit score and blah, 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 blah. So they're going to be able to give you something a lot more accurate, but you can always reach out to me if you have any other questions.